Question 1. Which of the following is true regarding the formation of a captive insurance company in Colorado? A. Captive insurance companies in Colorado must be incorporated as a non-profit entity. B. A feasibility study is required to assess the potential for the captive, but it does not need to be submitted to the Colorado Division of Insurance. C. Captive insurance companies must maintain a minimum level of capitalization as defined by the Colorado Division of Insurance. D. A Colorado captive insurance company is not required to file annual financial reports if it has been in business for less than 2 years. Answer: C. Captive insurance companies must maintain a minimum level of capitalization as defined by the Colorado Division of Insurance. Explanation: when forming a captive insurance company in Colorado, there are several regulatory and operational requirements that must be met, including the maintenance of a minimum level of capitalization as prescribed by the Colorado Division of Insurance. This ensures that the captive has the financial strength to operate effectively and meet potential claims. The minimum capitalization requirement is set by the division based on the risks assumed and other factors. Other options are incorrect because captives in Colorado can be for profit or non-profit depending on the structure, but the profit status does not impact the basic formation requirements. Feasibility studies must be submitted to the Colorado Division of Insurance to obtain approval for the captive's formation. Captive insurance companies, regardless of their age, are required to file annual financial reports with the Colorado Division of Insurance. Question 2. Mr. Davis is considering establishing a group captive insurance company in Colorado. What is a key factor that distinguishes group captives from single-parent captives? A. Group captives typically have a higher minimum capitalization requirement than single-parent captives. B. Group captives are formed by a single company pooling its resources with others, whereas single-parent captives are owned and operated by a single entity. C. Group captives only insure risks for their members' workers' compensation needs, while single-parent captives cover a broader range of risks. D. In group captives, all members must have the same industry type to qualify, whereas single-parent captives can be formed by entities from different industries. Answer: B. Group captives are formed by a single company pooling its resources with others, whereas single-parent captives are owned and operated by a single entity. Explanation: a key distinction between group captives and single-parent captives is that group captives involve multiple entities coming together to pool their resources, often to reduce premiums or access specialized coverage. Single-parent captives, on the other hand, are established by a single entity to insure its own risks. The other options are incorrect. Group captives generally have similar or lower capitalization requirements compared to single-parent captives because the risk is shared among the members. Group captives cover a broad range of risks, not just workers' compensation. Group captives allow membership from various industries if they do not require all members to belong to the same industry. Question 3, scenario-based. Mr. Johnson, the CFO of a large manufacturing company in Colorado, is tasked with evaluating whether forming a captive insurance company would benefit the company. He's concerned about the high cost of traditional insurance and the lack of control over claims handling his company has. A significant risk profile, but he's unsure about the regulatory complexities involved in forming a captive. Which of the following steps should Mr. Johnson take first to begin the captive formation process? A. Submit a formal application to the Colorado Division of Insurance for a captive license. B. Hire a third-party administrator (EPA) to handle the claims and premiums for the potential captive. C. Conduct a feasibility study and prepare a business plan to assess the risks and costs of forming a captive insurance company. D. Immediately begin underwriting policies for the company's risks through the captive without further evaluation. Answer: C. Conduct a feasibility study and prepare a business plan to assess the risks and costs of forming a captive insurance company. Explanation: before forming a captive insurance company, a feasibility study is a critical first step. It helps evaluate whether forming a captive will be financially viable and beneficial, taking into account the company's risk profile, potential cost savings, and operational requirements. The study is required by the Colorado Division of Insurance and is necessary for obtaining approval to establish the captive. Mr. Johnson should prepare a detailed business plan that outlines the company's risks, financial projections, and operational structure. Other options are incorrect because a formal application to the Colorado Division of Insurance can only be submitted after completing the feasibility study and business plan. A third-party administrator is not necessary at the initial stage. It is important later in the process to manage claims and premiums. Underwriting policies cannot begin until the captive is legally formed and properly capitalized following the feasibility and approval process. Question 4. Which of the following is a primary benefit of forming a captive insurance company in Colorado? A. Captive insurance companies are exempt from all state tax obligations. B. Captives allow for more control over claims management and risk retention strategies. C. Captive insurance companies are required to reinsure a percentage of their risks with commercial insurers. D. Captive owners are not responsible for the financial solvency of their captive insurance companies. Answer: B. Captives allow for more control over claims management and risk retention strategies. Explanation: one of the primary benefits of forming a captive insurance company is the increased control over claims management, premium setting, and risk retention strategies. This allows companies to better tailor their coverage to meet their specific needs, reduce insurance costs, and improve risk management. Other options are incorrect because captives are not exempt from all state taxes, and they must comply with state-specific tax requirements, including the Colorado captive insurance tax treatment. Captives have the option to reinsure some of their risks, but are not mandated to reinsure a set percentage with commercial insurers. Owners of captive insurance companies are legally responsible for ensuring the financial solvency of the captive in accordance with Colorado's regulatory framework. Question 5. Which of the following is a requirement for a captive insurance company's organizational structure under Colorado law? A. The captive insurance company must be structured as a cooperative with voting shares for policyholders. B. The board of directors must include at least 3 independent directors who are not affiliated with the captive's owners. C. The captive's management team must be located within the state of Colorado. D. Captive insurance companies must have a chief financial officer who is a certified actuary. Answer: B. The board of directors must include at least 3 independent directors who are not affiliated with the captive's owners. Explanation: Colorado law requires that the board of directors of a captive insurance company includes at least 3 independent directors who are not affiliated with the captive's owners. This requirement ensures that the captive operates with adequate oversight and governance, maintaining transparency and preventing conflicts of interest. The other options are incorrect because captive insurance companies do not have to be structured as cooperatives, nor do they require voting shares for policyholders. While Colorado law may have requirements for the domicile of certain service providers, the management team of the captive does not necessarily need to be located within Colorado. While the chief financial officer may have an actuarial background, Colorado law does not mandate that they be a certified actuary specifically. Question 6. Which of the following financial requirements must a captive insurance company meet in Colorado? A. Captives must maintain a surplus of at least $5 million to ensure solvency. B. Captives must file quarterly financial statements with the Colorado Division of Insurance, regardless of size. C. Captives must establish a reserve fund to cover future claims, but the reserve amount is not regulated by the Colorado Division of Insurance. D. Captives must provide evidence of financial solvency through an annual audit performed by an independent auditor. Answer: D. Captives must provide evidence of financial solvency through an annual audit performed by an independent auditor. Explanation: in Colorado, captive insurance companies must undergo an annual financial audit conducted by an independent auditor to ensure that they meet the required solvency standards and have the financial stability to meet their obligations. This audit is a critical part of maintaining regulatory compliance. The other options are incorrect because the surplus requirement is not a fixed $5 million for all captives. It depends on the risks being under it and other factors. While captives must file financial statements, quarterly filings are not required for all captives. They must submit annual filings at a minimum. Captives must establish reserves for claims, but the reserve amount is regulated and must be in accordance with the guidelines set by the Colorado Division of Insurance. Question 7. Scenario-based. Ms. Thompson, the risk manager for a medium-sized energy company in Colorado, is exploring the possibility of using a captive insurance company to manage the company's risks. She is particularly interested in improving her company's control over its claims handling and reducing premiums. Which of the following steps should Ms. Thompson take to ensure the captive is compliant with Colorado's regulatory framework? A. Begin underwriting the company's risks immediately by establishing the captive without delay, as long as she has board approval. B. Conduct a feasibility study and submit a business plan to the Colorado Division of Insurance to evaluate the viability of the captive. C. Form the captive under the assumption that the company will automatically qualify for the tax benefits afforded to captives. D. Set up the captive and begin underwriting claims, but defer any formal regulatory compliance filings until after the first year of operations. Answer: B. Conduct a feasibility study and submit a business plan to the Colorado Division of Insurance to evaluate the viability of the captive. Explanation: the first step in forming a compliant captive insurance company in Colorado is to conduct a feasibility study and prepare a business plan. This ensures that the company has a clear understanding of the risks, costs, and financial viability of forming a captive. The business plan and feasibility study must then be submitted to the Colorado Division of Insurance for approval before any underwriting or operations can begin. The other options are incorrect because MS Thompson should not begin underwriting risks immediately without the necessary approvals and the required feasibility study. The formation of a captive does not guarantee that tax benefits will be afforded, as there are specific tax regulations and requirements for captives in Colorado. Regulatory compliance filings cannot be deferred, as they are required to be submitted annually regardless of the first year of operations. Question 8. What is the primary purpose of using reinsurance within a captive insurance company? A. To transfer all of the captive's risks to another insurer, making the captive redundant. B. To reduce the overall premium burden on the captive and improve its solvency. C. To ensure that the captive complies with state regulations by shifting some of its financial responsibility. D. To increase the captive's liabilities and secure a larger reserve fund for future claims. Answer: B. To reduce the overall premium burden on the captive and improve its solvency. Explanation: reinsurance is used by captive insurance companies primarily to mitigate risk and reduce the burden of premiums. By transferring some of the risks to a reinsurance company, the captive can better manage its overall exposure and improve its solvency by distributing risks across multiple parties. The other options are incorrect because reinsurance does not transfer all of a captive's risks. It usually involves transferring a portion of the risks. Reinsurance is not about shifting financial responsibility to comply with regulations, it's a financial risk management strategy. Reinsurance does not necessarily increase the captive's liabilities or secure a larger reserve fund, and instead, it helps manage the risks effectively. Question 9. Which of the following is an essential characteristic of a captive insurance company's risk retention group? A. A risk retention group can only insure liability risks of its members. B. A risk retention group must consist of at least 100 members from unrelated businesses. C. A risk retention group can operate in multiple states, but only if it is registered with the National Association of Insurance Commissioners (NAIC). D. A risk retention group is required to file financial statements with the Colorado Division of Insurance quarterly. Answer: A. A risk retention group can only insure liability risks of its members. Explanation: a key characteristic of a risk retention group (RRG) is that it is formed to insure liability risks of its members, who are typically businesses or other entities sharing similar risk profiles. RRGs are often used by businesses in a particular industry to pool their liability risks and lower the overall cost of insurance. The other options are incorrect because RRGs do not need to have at least 100 members or be from unrelated businesses. RRGs can operate in multiple states, but they must be licensed in each state in which they operate, not just with the NAIC. Financial statements are required annually, not quarterly, unless specified by the Colorado Division of Insurance or under particular circumstances. Question 10. Which of the following best describes the role of independent auditors in the captive insurance industry? A. Independent auditors are responsible for the daily operations of the captive, including claims management. B. Independent auditors perform an annual audit to ensure the financial statements of the captive comply with statutory accounting principles (SAP). C. Independent auditors are only required for large captives with more than 50 members. D. Independent auditors are hired to assess the captive's insurance premiums, but not its solvency. Answer: B. Independent auditors perform an annual audit to ensure the financial statements of the captive comply with statutory accounting principles (SAP). Explanation: independent auditors are essential in ensuring that captive insurance companies maintain financial transparency and solvency. They perform annual audits to ensure the captive's financial statements comply with statutory accounting principles (SAP) and regulatory requirements. This helps ensure that the captive is financially stable and meeting its obligations. The other options are incorrect because independent auditors do not manage the daily operations of the captive or handle claims management. Independent auditors are required for all captives, not just those with more than 50 members. Independent auditors assess the overall financial health of the captive, including solvency and compliance with SAP, not just insurance premiums. Question 11. Which of the following is a potential disadvantage of forming a captive insurance company in Colorado? A. Limited ability to customize insurance coverage for the parent company's unique risks. B. Increased regulatory burden and reporting requirements compared to traditional commercial insurance. C. Captives are automatically exempt from federal income taxes, reducing the tax burden. D. Captives can only insure risks for entities located within the state of Colorado. Answer: B. Increased regulatory burden and reporting requirements compared to traditional commercial insurance. Explanation: one of the potential disadvantages of forming a captive insurance company is the increased regulatory burden and reporting requirements. Captives must adhere to both state and federal regulations, file detailed financial statements, and maintain sufficient reserves. This can be more time-consuming and costly than simply purchasing traditional commercial insurance. The other options are incorrect because captives are designed to allow customization of insurance coverage for the parent company's unique risks. Captives are not automatically exempt from federal income taxes. They must comply with both state and federal tax regulations. Captives can insure risks for entities located outside of Colorado, not just within the state. Question 12. What is the minimum capital requirement for a captive insurance company to operate in Colorado? A. $500,000. B. $1 million. C. $2 million. D. $3 million. Answer: B. $1 million. Explanation: in Colorado, the minimum capital requirement for a captive insurance company to operate is $1 million. This capital ensures the financial solvency of the captive, allowing it to meet its obligations. The other amounts are incorrect as they do not reflect Colorado's specific regulatory requirements. Question 13. Which of the following is a common reason businesses form a captive insurance company? A. To ensure they never need to pay for insurance premiums again. B. To gain greater control over their insurance coverage and reduce costs. C. To avoid all state insurance regulations. D. To have unrestricted access to public funds in case of a financial crisis. Answer: B. To gain greater control over their insurance coverage and reduce costs. Explanation: businesses often form captive insurance companies to have greater control over their insurance programs, allowing them to tailor coverage to their specific risks and reduce the overall costs of insurance premiums. The other options are incorrect because captives still require premiums to fund insurance coverage. Captives must comply with state and federal regulations. Captives are not a means of accessing public funds, they are private entities that manage risks for their owners. Question 14. Which of the following types of risks is commonly insured by captive insurance companies? A. Only property risks related to physical damage. B. Only auto-related liability risks. C. A wide range of commercial risks, including property liability and workers' compensation. D. Only cyber risks and data breaches. Answer: C. A wide range of commercial risks, including property liability and workers' compensation. Explanation: captive insurance companies are commonly used to insure a wide range of commercial risks, including property liability and workers' compensation, allowing businesses to have more control over these coverages. The other options are too specific and do not fully represent the diverse range of risks a captive can cover. Question 15. Scenario-based. A Colorado-based technology firm wants to form a captive insurance company to cover the risks associated with product liability, cyber attacks, and employee health insurance. What should the firm do first to ensure the captive's formation is legally compliant in Colorado? A. Submit an application to the Colorado Division of Insurance for approval, including a detailed business plan and financial projections. B. Begin underwriting coverage immediately once the firm's board approves the formation of the captive. C. Wait until the next fiscal year to start the process, as captives cannot be formed mid-year. D. Register with the National Association of Insurance Commissioners, NAIC, before applying for approval from the Colorado Division of Insurance. Answer A. Submit an application to the Colorado Division of Insurance for approval, including a detailed business plan and financial projections. Explanation: the first step to form a legally compliant captive insurance company in Colorado is to submit an application to the Colorado Division of Insurance, including a detailed business plan, financial projections, and a feasibility study. This step ensures that the company meets all the regulatory requirements before underwriting any risks. The other options are incorrect because underwriting coverage cannot begin without the necessary regulatory approvals. There is no requirement to wait until the next fiscal year to start the process. Registration with the NAIC is not a prerequisite for applying to the Colorado Division of Insurance. Question 16. Which of the following entities may act as the fronting insurer for a captive insurance company? A. A state-run insurance agency. B. A commercial insurance company providing coverage for risks beyond the captive's retention limit. C. The parent company of the captive insurance company. D. A third-party administrator managing claims for the captive. Answer: B. A commercial insurance company providing coverage for risks beyond the captive's retention limit. Explanation: a fronting insurer is typically a commercial insurance company that issues insurance policies on behalf of a captive for risks that exceed the captive's retention limit. The fronting insurer assumes the liability for the entire policy, while the captive may assume a portion of the risk or provide reinsurance. The other options are incorrect because state-run insurance agencies are not typically used as fronting insurers. The parent company does not act as a fronting insurer but may be the beneficiary of the coverage. A third-party administrator does not provide coverage but manages claims for the captive. Question 17. What is a risk retention group in the context of captive insurance? A group of businesses that form a captive to insure only property risks. B. A mutual insurance company formed by a group of similar businesses to retain their liability risks. C. A single entity that insures only the parent company's risks. D. A reinsurance company that assumes risks from other captives. Answer: B. A mutual insurance company formed by a group of similar businesses to retain their liability risks. Explanation: a risk retention group (RRG) is a mutual insurance company that is formed by a group of similar businesses, such as those in the same industry, to retain their liability risks collectively. It allows the members to share the cost of liability coverage, reducing overall premiums. The other options are incorrect because RRGs can insure a variety of liability risks, not just property risks. RIGS are formed by multiple businesses, not a single entity. RIGS are not reinsurance companies if they directly insure the liability risks of their members. Question 18. What is the role of a captive insurance company's actuary? A. To manage claims and oversee policyholder disputes. B. To assess the financial viability of the captive and ensure adequate reserves are maintained. C. To market the captive's insurance products to potential clients. D. To provide legal counsel regarding regulatory issues and state insurance law. Answer: B. To assess the financial viability of the captive and ensure adequate reserves are maintained. Explanation: the role of an actuary in a captive insurance company is to assess the financial viability of the captive, estimate the appropriate premiums, and ensure that sufficient reserves are maintained to cover future claims. Actuaries play a critical role in setting the financial foundation for the captive's success. The other options are incorrect because claims management is typically handled by claims adjusters or third-party administrators, not actuaries. Actuaries do not market insurance products. Actuaries are not legal experts and do not provide legal counsel. Question 19. Which of the following is a requirement for the financial solvency of a captive insurance company in Colorado? A. The captive must have an actuary on staff to calculate claims reserves. B. The captive must maintain an amount of capital that exceeds the risks it is insuring. C. The captive must purchase a surety bond to guarantee solvency. D. The captive must be fully funded by its parent company with no external capital. Answer: B. The captive must maintain an amount of capital that exceeds the risks it is insuring. Explanation: for financial solvency, Colorado requires that a captive insurance company maintain sufficient capital to cover the risks it is insuring. This ensures that the company can meet its obligations and remain solvent. The other options are incorrect because, while an actuary is important, it is not a requirement for all captives to have one on staff. A surety bond is not required for solvency but can be used as a tool for risk management. Captives do not need to be fully funded by the parent company. They may raise capital from external sources depending on their structure. Question 20. Which of the following must be included in the business plan submitted to the Colorado Division of Insurance when forming a captive insurance company? A. The names of all policyholders the captive will insure. B. The legal structure and ownership details of the captive. C. The proposed premium rates for all lines of coverage. D. The name of the reinsurance company the captive will work with. Answer: B. The legal structure and ownership details of the captive. Explanation. When forming a captive insurance company in Colorado, one of the essential elements that must be included in the business plan submitted to the Colorado Division of Insurance is the legal structure and ownership details of the captive. This allows the Division of Insurance to understand the organizational setup, ownership structure, and governance of the captive. The other options are incorrect because A. The names of all policyholders are not typically required to be included in the initial business plan, as it is not necessary for the regulatory approval process. C. The proposed premium rates for all lines of coverage might be a part of the business plan but are not typically required in detail in the initial submission. The rates can be adjusted later as the captive develops its operations. D. The name of the reinsurance company may be relevant for certain types of captives, but is not necessarily a mandatory part of the initial business plan submission. Question 21. Which of the following is a key factor in determining the appropriate capitalization requirements for a captive insurance company in Colorado? A. The number of policies written by the captive. B. The risk retention level of the captive. C. The type of investment strategy the captive will use. D. The number of claims the captive expects to handle. Answer. B. The risk retention level of the captive. Explanation. The capitalization requirements for a captive insurance company in Colorado are based on factors like the risk retention level, which helps determine the appropriate amount of capital needed to cover potential claims. Other factors such as the number of policies or expected claims are secondary to understanding the level of risk retained by the captive. Question 22. Which regulatory requirement must a Colorado captive insurance company adhere to in relation to its financial reporting? A. Quarterly submission of unaudited financial statements to the Colorado Division of Insurance. B. Biannual solvency assessments by an independent third party. C. Annual filing of audited financial statements to the Colorado Division of Insurance. D. Monthly reports on claims activity to the Colorado Division of Insurance. Answer. C. Annual filing of audited financial statements to the Colorado Division of Insurance. Explanation. Captive insurance companies in Colorado are required to submit audited annual financial statements to the Colorado Division of Insurance. This ensures compliance with regulatory solvency requirements and provides transparency in the captive's financial health. Other reporting requirements like quarterly or monthly filings are typically not required unless specified. Question 23. Mr. Davis is in the process of setting up a captive insurance company. He is unsure about the feasibility of his business plan. Which of the following steps should he take first to proceed? A. Submit the business plan to the Colorado Division of Insurance for review. B. Perform a feasibility study to assess the financial viability of the captive. C. Obtain an independent audit of his business plan and risk models. D. Complete the required forms for tax registration before the business plan submission. Answer. B. Perform a feasibility study to assess the financial viability of the captive. Explanation. Before proceeding with the business plan submission, it is important for Mr. Davis to conduct a feasibility study to assess the financial viability of the proposed captive insurance company. This includes evaluating potential risks, premiums, claims, and the capital needed. This study ensures the business plan will be realistic and compliant with Colorado's regulations. Option A is incorrect because submitting the business plan without a feasibility study could lead to delays or rejection. Question 24. Which of the following is typically considered a benefit of establishing a captive insurance company? A. The ability to transfer risks directly to reinsurance markets without additional cost. B. Control over underwriting, claims management, and premium rates. C. Exemption from all federal and state insurance taxes. D. Guaranteed profitability due to lower operating costs compared to traditional insurers. Answer. B. Control over underwriting, claims management, and premium rates. Explanation. A key benefit of a captive insurance company is the control over underwriting, claims management, and premium rates, allowing the owner to tailor the coverage to the specific needs of the insured party. This is in contrast to traditional insurance models, where underwriting and pricing are typically set by the insurer. Captives do not automatically guarantee profitability, nor do they exempt companies from taxes, as the IRS and state regulations impose certain tax obligations. Question 25. Which of the following is a mandatory requirement for a captive insurance company licensed in Colorado? A. The captive must insure at least 10 unrelated businesses. B. The captive must maintain a minimum level of risk retention. C. The captive must submit a statement of actuarial opinion for its reserves. D. The captive must have a board of directors composed of independent members only. Answer: C. The captive must submit a statement of actuarial opinion for its reserves. Explanation: captive insurance companies in Colorado must submit a statement of actuarial opinion regarding their reserves. This statement ensures that the reserves are adequate to cover the expected future claims, while maintaining a minimum risk retention level. Option B may be part of the business strategy. It is not universally mandatory, nor is the requirement for independent board members. Option D in all cases. Question 26. What is the purpose of the Colorado Division of Insurance's annual examination of captive insurance companies? A. To assess the company's compliance with financial and operational regulations. B. To determine whether the captive qualifies for tax exemptions. C. To review the profitability of the captive for investment purposes. D. To inspect the reinsurance agreements of the captive. Answer A. To assess the company's compliance with financial and operational regulations. Explanation: the Colorado Division of Insurance conducts annual examinations of captive insurance companies to assess their compliance with financial and operational regulations. These examinations ensure that captives are operating within the framework established by Colorado laws and regulations, particularly regarding solvency and business practices. The division is not involved in determining tax exemptions or profitability reviews. Question 27. Which of the following best describes a rent-a-captive insurance model? A captive that is formed by a group of businesses to share the risks of a specific industry. B. A model where a company rents a portion of a captive's insurance capacity without creating its own captive. C. A captive that insures only risks associated with real estate properties. D. A model where an individual rents out insurance policies to other businesses. Answer: B. A model where a company rents a portion of a captive's insurance capacity without creating its own captive. Explanation: a rent-a-captive model allows a company to access the insurance capacity of an existing captive without forming its own. This can be beneficial for smaller companies or those just starting out who need insurance coverage but do not want to bear the full costs and regulatory burdens of forming a separate captive. Question 28. Which of the following best describes the role of a captive manager in the formation of a captive insurance company? A. The captive manager is responsible for underwriting risks and setting premiums. B. The captive manager assists in the legal formation, regulatory compliance, and day-to-day operations. C. The captive manager ensures the investment portfolio meets financial solvency requirements. D. The captive manager acts as the primary reinsurer for the captive. Answer: B. The captive manager assists in the legal formation, regulatory compliance, and day-to-day operations. Explanation: a captive manager plays a crucial role in assisting with the legal formation, regulatory compliance, and overall day-to-day operations of the captive insurance company. They provide guidance on the formation process, handle regulatory filings, and help ensure compliance with local insurance laws. They are not primarily responsible for underwriting or reinsurance activities, which are typically handled by specialized parties. Question 29. What is a primary advantage of using excess and surplus lines insurance in the context of captive insurance? A. It allows captives to avoid regulatory oversight by the Division of Insurance. B. It provides coverage for high risk or unique exposures that cannot be easily covered through standard policies. C. It guarantees that the captive will receive a premium rebate if claims are lower than expected. D. It allows the captive to offer coverage that is tax exempt under state law. Answer: B. It provides coverage for high risk or unique exposures that cannot be easily covered through standard policies. Explanation: excess and surplus lines insurance are designed to cover high risk or unique exposures that are not easily addressed by standard insurance policies. In the context of a captive, these lines can provide flexibility to cover specific risks that may not be available in the traditional insurance market. The other options are incorrect because excess and surplus lines do not provide tax exemptions or premium rebates. Question 30. In the context of captive insurance, which of the following is a common reason for implementing a reinsurance arrangement? A. To reduce the capital requirements for the captive. B. To directly fund the reserves for policyholder claims. C. To transfer risks to another insurer for greater risk diversification. D. To eliminate the need for regulatory filings and compliance. Answer: C. To transfer risks to another insurer for greater risk diversification. Explanation: reinsurance arrangements are commonly used in captive insurance to transfer risks to another insurer, providing greater risk diversification. This allows the captive to manage its exposure to large losses and maintain solvency. It does not eliminate the need for regulatory compliance, option D, or directly fund reserves, option B. Reinsurance does not typically reduce capital requirements, option A, but it can help manage risk more effectively.